Welcome to today's options trading tutorial. I'm going to explain the synthetic call options strategy, a powerful technique that every serious trader should understand. A synthetic call option replicates the payoff of a long call option by combining a long stock position with a long put option. This strategy involves buying shares of stock and simultaneously purchasing a put option on the same stock with the same expiration date. Let's dive deep into how this strategy works and when you should use it. First, let's address whether this is an income strategy or capital gain strategy. The synthetic call is primarily a capital gain strategy. You're positioning for upward price movement in the underlying stock, aiming to profit from appreciation rather than generating regular income. This strategy needs a bull market or strongly bullish outlook on the specific stock you're trading. Unlike neutral strategies, synthetic calls require directional conviction. You need the stock price to move significantly higher to be profitable. Regarding volatility, this strategy actually benefits from low to moderate volatility when entering the position. Lower volatility means cheaper put options, reducing your overall cost basis for the synthetic call. However, you do want volatility to increase after establishing the position, as this benefits both the stock and put components. Let's create a practical example using Heinz. Suppose Heinz stock is trading at £50 per share. Step 1. We buy 100 shares of Heinz at £50 each, investing £5,000. Step 2. We simultaneously buy a put option with a £50 strike price, expiring in 3 months, costing £2 per share. Our total investment is £5,200, £5,000 for the stock plus £200 for the put option. If Heinz rises to £60 at expiration, our stock gains £1,000. The put expires worthless, giving us a net profit of £800. If Heinz falls to £40, our stock loses £1,000, but the put option gains £1,000, limiting our loss to just the put premium. Our break-even point is £52 per share, the original stock price plus the put premium paid. For entry, look for stocks with strong fundamental catalysts, technical breakout patterns, and relatively low implied volatility on the put options. Enter when you have high conviction about upward price movement, but want downside protection during the holding period. Ideal entry points are often after earnings announcements or before anticipated positive catalysts. For exits, you can close both positions simultaneously when your profit target is reached, typically 20 to 30% gains. Alternatively, if the stock moves as expected, you might sell the put option early and hold the stock for further gains. Set stop losses based on technical levels rather than arbitrary percentages, as the put provides natural downside protection. The primary risk is limited to the put premium if the stock price remains below your break-even point at expiration. Time decay works against you on the put option, gradually reducing its value as expiration approaches. Maximum loss occurs if the stock price equals the strike price at expiration, where you lose the entire put premium. There's also opportunity cost as you're tying up significant capital compared to simply buying call options. The reward potential is theoretically unlimited, as you benefit from every pound the stock rises above your break-even point. This strategy offers better risk-reward characteristics than buying stock alone, thanks to the put protection. However, it requires larger capital commitment than buying calls outright, affecting your overall portfolio allocation. To summarize, synthetic calls are capital gain strategies requiring bullish market conditions and benefiting from low entry volatility. They provide unlimited upside potential with limited downside risk, making them excellent for high-conviction trades. Remember to always manage your risk, set clear profit targets, and never risk more than you can afford to lose. Thanks for watching, and remember to subscribe for more options trading strategies.